Good morning, everyone. Thank you for being here for the this office's, the new administration and the Controller's Office first annual comprehensive financial report. As hopefully everybody knows, this is the annual report that our office produces. It's the financial record for the city of Pittsburgh. So I'm going to get started. We're going to go through some of the slides, and then hopefully we'll have a nice Q&A, and I'm happy to answer any questions too as things come up along for the next 15, 20 minutes. So big picture, thank goodness for the American Rescue Plan. The city of Pittsburgh was below budgeted revenues by $9.5 million in 2023 and below budgeted tax revenue by $20.6 million when you look at the general fund. For the city as a whole, we collected $843 million in revenue total. We spent $733 million. Again, we are strongly utilizing ARPA funds. In total, revenue was up 8.6%, which includes ARPA and investment income, which are two things that we cannot rely on moving after this year. Expenditures were up 10.4%, which is a drastic demonstration of expenses outpacing revenue. And now we're going to go through slide by slide. Again, as you have questions, don't hesitate to interrupt me. This is where our money comes from. Real estate revenue finished $10 million lower than budgeted. Deed transfer finished $21 million lower than budgeted. And payroll prep finished $11 million lower in 2023 than in 2022. But what I will point out with that revenue line item is it was above budget. So 2022 with payroll prep was an anomaly. Parking and amusement have effectively rebounded to pre-pandemic levels. I want to applaud the folks in the city who apply for grants. That revenue line item increased in 2023 over 2022 by about $43 million. That is something that the city needs to continue to pursue. Charges for services was also up. That's EMS billing primarily. And unrestricted investment earnings were up $19 million over 2022 numbers. The city has to continue to work on expanding tax-based revenue while recognizing the changing market conditions. The last 5 years have demonstrated the importance of avoiding excessive reliance on any one revenue stream. Next slide. This is where your money goes. No significant changes from last year other than public safety being down about 3%, likely due to staffing issues with the Pittsburgh Bureau of Police and EMS. Next slide. The unassigned fund balance. So what I want to point out here is for the purposes of the annual comprehensive financial report, we use modified accrual accounting. If you want to talk to our office's CPA, she's here and she can explain it more adequately than I can. But what I'll tell you is that we, for Treasury, for the Treasurer's Office here, OMB, in our office, just in practice, we use cash basis accounting. So when money hits, that's when it counts. But for the modified accrual accounting, I'll use the American Rescue Plan as the example. We received $335 million in additional federal tax revenue in 21 and 22. It's two deposits. That money didn't actually count until it hit our bank account. It stayed in a deferred revenue account. So for 2023, that wouldn't match up with what you see in a typical budget, because if interest came in from November and December interest investment earnings, and it hit in January or February, we pull that into 2023 finances. So that's the difference. And again, Jamie's here if anybody has more specific questions relates to that. But the fund balance is quite healthy at this point. Next slide. EIT, this is the earned income tax that our city residents pay on wages. This demonstrates, and Controller Lamb, my predecessor, also talked a lot about this during these annual press conferences, that the cost of city government falls very heavily on the shoulders of the people who live here. When you combine earned income, real estate, and deed transfer, more than half of all city revenue comes from city residents. LST remains stable. The big concern I have with LST is we'll use Giant Eagle, who's leaving Lawrenceville and moving to Cranberry. Every single person that the corporate offices, excuse me, everybody who works out of that corporate office is paying a $52 a year LST tax. When they move to Cranberry or wherever they're going, that we aren't unable to collect that from those workers. And that's a big concern to me moving forward, and it's just something we need to continue to monitor. Other categories, this is pretty self-explanatory. Amusement and parking continue to move up and rebound. Things look very similar to what they looked like before the pandemic. Payroll prep, as we mentioned, decreased by $11 million. Again, was over budget, though, in 2023. And real estate is effectively stagnant. Gross bonded debt, you can see when we left Act 47, we continued to borrow again. Invested portfolio is the shiniest part of the entire ACFR. The pension fund continues to be very, very healthy. A lot of that credit goes to Controller Lamb for his work advocating for the parking asset, and things are very, very healthy, and our pension liabilities are under control. So with that, I'm going to just touch a little bit on. Does anybody have any questions before we just discuss 2024 and where we are in Q1? Okay. So the first thing I'll just let everybody know, expenditures are at 125% of what they were in Q1 of last year. However, there was a large pension payment that was paid later in the year last year that we paid in Q1 of this year. That was about $27 million of the $40 million increase year over year. Expenditures relating to personnel are likely to go up. We've one CBA that's been ratified, one that's pending with the PJCBC, and then the medics are still negotiating. Real estate continues to be a problem. Refunds owed and continuing lowered common level ratio. We expect another significant drop in revenue along with owing refunds. We have not yet paid any bulk refunds yet in real estate. Dispositions from BPAR, have accumulated to $7.4 million in refunds and $3.6 million in lost revenue. Some of this might be litigated, but we will likely owe a significant portion of that. $1.5 billion of property was appealed for the 2024 tax year. Based on 2023 trends, we anticipate an additional loss of close to $2.8 million from those appeals. Deed transfer was the largest variance in revenues from last year. This year's Q1 numbers are slightly below last year's. It's reasonable to expect that the city will be at least $10 million lower than budgeted in 2024. Given the dynamics of a presidential election year, I believe it's pretty unlikely that the Federal Reserve will do anything to touch interest rates, which will likely continue to keep the real estate market below where it was 2 years ago. The facility usage fee can best be described as a big unknown right now. The city of Pittsburgh resumed collection of the facility usage fee in Q2. Because of how that's collected on a quarterly basis, we really won't see those revenues until June or July of this year. It's in litigation, I think, as everyone here knows. Pending at the Supreme Court. The Supreme Court could either defer to the lower two courts, both of which have ruled it unconstitutional. They could elect to hear the case and make their own decision. But at best, I would describe the facility usage fee as a big unknown with city finances moving forward. I think at a minimum, we didn't collect it in Q1, so you'll see a hit there. But not knowing what the courts will elect ultimately to do, I think we need to be very, very concerned about counting on that revenue in the years ahead. Licensing and permits are a bright spot for 2024. Increase in investment and construction brightens all of our neighborhoods and makes things better around the city. Assuming the LRTA becomes law, I do think those figures will continue to increase. We need to make permitting as easy as we can in the city, making sure that people are in safe workplaces, of course, but that we're allowing permitting to occur. If at best, I think we will assume that we'll collect all $17 million from licensing and permits, if not exceed that budget line item. And then interest earnings, which is the last thing I'll touch on with Q1. The city has done a phenomenal job. I want to give big credit to the finance department who does our investments on behalf of the city. Investment earnings are exceptionally high, and it is really a boon to our city revenue. I think we can rely on that through this year, and what will be seen is what things look like moving forward. But right now, we're collecting between 4% and 5% on all of our investment accounts. Any questions? I just want to also thank my colleagues in the City Controller's Office. This is a huge report. It's 255 pages this year. It takes months upon months to do. Jamie Zala, CPA, is our office's new Chief Accounting Officer. She started in January and literally rolled up her sleeves on day one and got started. My other colleagues in her office, Carrie, Kim McGann Hertzer, who's retired but did a lot of this work last year, Vicki Clark, Frank Thurner, Sarah Simmers, Tamika Phillips, Rhonda Rawlings, who also retired last year, Brian McGregor, Liz Dilly, Coleman, Doug Anderson, Namita, Marcus Jester, Mark Pitak, Jay Weiland, Janice. This is an awesome and amazing office, and I feel so fortunate to work here with my colleagues every single day. This report would not be possible without them. The work that is produced by this office would not be possible without them. So I think very infrequently do we acknowledge and thank the people that, spend their days doing and supporting principals and roles like this. And I'm grateful to work here and to be working alongside all of them. So Meyer Dussel is also our accounting firm, and they're wonderful to work with. So thank you. Thanks to the Finance Department, too, and OMB for their help in putting this report together. And I am glad to take questions.
You've said in the past that you have concerns about the interest estimates. Has that changed?
I feel very confident, based on our conversations with OMB leadership and the city treasurer, Jen, for 2024. And I think that, while it is still a concerning point moving forward, and I think it's unlikely that interest rates will remain where they are for the next 5 years, I think that, I don't know if there's anyone that would agree with that. I do think for the 2024 figure, we will, at a minimum, meet budget with investment earnings.
You mentioned that expenditures last year were up 10.4%. Is there any reason for why that might be? We've resumed hiring, so that's the one thing that continues. 2020, 2021, there was a hiring freeze. I don't know that there's anything specific or concerning that we see, but it's just a general growth. Expenditures are growing faster than revenue.
Do you expect that to continue this year?
Yes, unfortunately.
We've heard you say that City Council and the Mayor's Office should start, preparing for potential financial problems ahead. Can you kind of give some examples of what that preparation might look like and what the city realistically could do this year to ease potential problems in the out years?
The first thing I would say is, just acknowledging the fact that we have budgeted deficits in 2025 and 2026. I mean, that's going to happen, and starting that conversation with city residents. I mean, our paving budget's going to be cut by 75% over the next 3 years. We are not going to be investing in capital assets and capital programming or capital construction like we have been, and making sure that city residents recognize what's coming. The other thing I would say is we need to be practical about staffing. I mean, public safety is understaffed. I think there are very few people that would say that that wasn't an issue, and B, not acknowledge that, we need to change that. But making sure that the positions that we're hiring prioritize public safety, public works, and, looking at every single department and seeing where there's cost savings. We have been buoyed by the American Rescue Plan Act for the last 4 years. The money, for those of you who don't know, the money has to be encumbered by the end of this year and spent by the end of 2026. The reason we will not have an operating deficit in 2024 is because of the American Rescue Plan Act. So I just think starting to have a more realistic conversation, both among leaders within this building and then with the public and with residents, would really benefit all of us.
What is the answer to potential financial struggles? Does that look like a tax increase for residents?
So that's a conversation. This office doesn't budget. We approve revenues. I think everything should be on the table. I think the first conversation that needs to happen is we have 5 large nonprofit employers in the city of Pittsburgh. That
we need to have, as a city, we need to have a conversation with those nonprofit partners and ask about revenues and pilots. Voluntary payments should be part of the conversation, absolutely. We also need to have a conversation around how to grow our regional economy and how to grow the city of Pittsburgh. If 5,000 people moved into the city of Pittsburgh over the course of the next 5 years, a lot of our financial issues would not be nearly as severe as I would expect them to be. New residents pay a deed transfer tax, new residents pay property taxes, new residents pay wage taxes, and that would change the city's finances if we were doing more things to get folks to stay here. I didn't grow up in Pittsburgh. I went to Pitt and I stayed here. And we need to do a better job of recruiting the thousands of college students that we have living within the city to stay.
The mayor's office has seemed to say that because of the debt payment schedule, it's going to be tough in 25 and 26 and then get a lot better. So they're kind of saying we just need to get through these 2 years. Is that how you see it?
Well, their own budget accounts for a deficit in 2028. So 2027, just for some historical context, the city deferred, which was, in my opinion, the right thing to do, pension payments in 20 and 21, not knowing what city finances were, what was going to happen, not knowing that the American Rescue Plan was coming, and we deferred them to 25 and 26. So that is one reason that you'll notice a ballooned pension obligation payout in those 2 years, or maybe it wasn't pension, it was a bond payment, excuse me. But their own budget recognizes that there will likely be a deficit in 2028. So while I agree that things get better after 25 and 26, I think real estate is still a big unknown. The facility usage fee is still a big unknown. And I think investment earnings in those years that are a bit further away are a lot less realistic at 16 million annually. So if those line items still look, in my opinion, rosy, they ignore some key hurdles that we have to get through. Kelly.
City Council just required your office to now certify
Revenue
projections longer term. There's early stage work to require the same thing for expenditures. As you're, taking a look at city finances, how important would it be for your office to sort of serve as that check and balance?
So this office doesn't budget. We are not the budgeting entity for the city of Pittsburgh. The one thing I would say is, at a minimum, the modification of city code to require a 5-year instead of the subsequent year will spur more conversation around expected expenditures. I'll use 25 to 26. If you look at the current proposed budget for those 2 years, there's a $5 million increase in the salary line items from 25 to 26, which I don't believe covers the CBA salary increases, let alone for the non-union workforce in the city of Pittsburgh. So I think that we need to have more conversations more broadly around the future of expenditures and the future of revenue. And I do think that the city council's change of code, requiring our certification will prompt that.
This office has, for the last 4 years, said it's okay because we've had ARPA money, but that won't be the case next year. And there's a lot of we need to have conversations and we need to work together, but when is it too late for those conversations to start?
It's never too late, but it's also never too early. I'm a big believer in collaboration. Every municipality in the United States is dealing with these issues with downtown real estate. This is a byproduct of the pandemic. In my opinion, it's the number one flaw with the American Rescue Plan Act, is it doesn't allow the ARPA to support these changes in downtown real estate. Those were things that were never going to be realized in the 18 months after. They're when leases expire and companies can, shrink their footprint. So these are not things that are attributable to one administration or one city. This is not a Pittsburgh problem. This is a city problem, and this is happening across the country. And, I think the sooner we start that conversation to inform council, to inform the mayor, to inform this office of, an exchange of ideas, and then we are communicating that to the city so that, if they have a pothole or a rough street that they've been begging to get repaved, it's probably not going to happen until 2027 at best. So I think having those conversations is the best thing we can do for city residents.
Last year, Controller Lamb said that the city had largely bounced back from the pandemic, and he seemed to have kind of a more optimistic tone than some of the concerns that we're hearing from this office and from some members of council now. Has anything in particular changed over the last year, or is it just a realization that, the next 2 years are tight?
So I think it's both. I think with the deed transfer tax in particular, we finally saw interest rates, home purchase and buying and selling catch up to interest rates, which forced it to a significant slowdown. I think that, the facility usage fee at that point a year ago was still, in my opinion, a pretty solid revenue source. We were under Act 47 for 15 years, and for those 15 years, the state basically signed off on that being a permissible revenue source. So courts have intervened and have disagreed with that assessment. And I think real estate, the changes in downtown, I think we all could have predicted that this was coming. And if you look at 2019 and 2020 budgets for real estate revenue, we have lowered expectations. That has absolutely happened. I think that we are just dipping lower than we anticipated. And I will also just, the school district is the entity that primarily challenges assessment appeals, and we're winning a lot of the assessment appeals, particularly in the East End, but we're really, downtown is really hurting us, and I don't know that a year ago we could have predicted where things would be in terms of, the BPAR decisions. So I think things have changed, and I do also think that we knew 25 and 26 were going to be particularly bad. And again, I think the statement, at least in the revenue certification letter, has been, in totality, these revenue expectations are in line with what we think we'll see. And we had articulated then, and I would articulate now, the American Rescue Plan is the reason that that we are weathering this storm as it is right at this moment.
Can you give a picture to residents that maybe haven't been paying attention to the downtown real estate situation of just kind of where things stand compared to pre-pandemic when it was booming?
Sure. So this city of Pittsburgh, 25% of our real estate tax base is within the Golden Triangle. Businesses that were down here, commercial property, is worth less than it was before the pandemic. The buildings are half occupied. Leases are contracting in size. Companies are shrinking their footprint downtown in commercial space. So the conversation right now, primarily upstairs, has been around conversions and the opportunity for conversions. I think anything on the table to preserve the downtown tax base and the downtown job base should be prioritized with the city at this moment. But that's basically it, is downtown's value is shrinking because people aren't working from office buildings in downtown Pittsburgh 5 days a week like they were in 2019, 2018, and the years prior.
Is there a real fear to residents that, these services that they expect all the time could be, cut or dropped what they're normally used to?
I think that the conversation has started. I do believe that folks are aware of what's going on generally downtown. Downtown's booming at night. You come down for a show, you come down for dinner, you can't get parking, but 9 to 5, things are a little bit quieter, and particularly on Mondays and Fridays when folks tend to be more likely to work from home. So I think what city residents, they know that there's an issue downtown. They understand this has been an ongoing conversation with local media for the last 3 or 4 months. I don't think that we should cut city services. I do not believe that DPW or public safety should be touched. I think those are the top 2 priorities of this government, keeping people safe and keeping things clean. I just think that some of the other programming that the city offers, we should do everything we can to make sure that we're mitigating against the effects of the pandemic, which is this downtown contraction in the tax base, to make sure that nothing else is affected.
So just to clarify, you're saying definitely not cutting essential services, but what about things like, we've heard some controversy over grant making and some of those programs that are a little bit less essential to the core services of the city? What would you think about those programs?
What I think is that there needs to be a conversation around everything. I would never advocate for cutting public safety, and I will never advocate for cutting public works. A lot of the grant making that the city does is actually funneled through federal dollars, CBDG money. the city's merely a pass-through. So getting rid of that wouldn't do anything to help the city's finances because we can't use it on other things. But I do think that the city is not a grant-making entity. We support federal programming that supports nonprofits in our community through CBDG and other like sources. But I do think that we need to look at every single expense that the city pays out on an annual basis and determine whether or not it's needed, particularly in these 2 years that are going to be rough.
Talk a little bit about the paving budget being decreased on the line. Can you give it a little more detail?
Sure. The paving budget, as you'd see in the capital budget, is shrinking considerably. It's going from about $20 million to about $5 million in 2025 and 2026. And those are services that people see, right? You see when someone's paving, and it's a pain while it's going on, but when you're driving down the road a month later, it's pretty great. So those types of things I think, should be prioritized. And I understand that the administration wants to get caught up on capital projects, and I'm not going to disagree with that, but I do think with paving in particular, that's something that residents will feel, see, and notice when we're not doing the paving that we were doing in previous years.
A lot of this court has supported the red flags you've been raising for a couple of months now. Is there anything in this that we haven't heard before?
No. I will say that our office has worked really diligently to put together the pieces of basically informing council and the mayor and serving as that watchdog. And so I do think that our assessment, I think we sent that letter in March, right? Yeah, okay. The letter that we sent in March was pretty accurate to where we find ourselves at the conclusion of 2023 moving into 2024. The deed transfer tax is something that I actually haven't talked a lot about, but it is very concerning. It was a $21 million budget shortfall is significant. And again, the facility usage fee just continues to be this massive unknown, but no.
So you raised all those red flags, but the mayor's office has told me just in the last few days that they have no plans to cut costs or create new revenue or generate new revenue sources. Is that realistic?
The tone of next year's ACFR will be very different. So no, I don't believe it's realistic. And I do believe that expenditures are outpacing revenue, period, by more than 2%. And that is accounting for the American Rescue Plan Act. And that money goes away in December, effectively. Encumbered projects will still move forward, but it is not a reliable source of revenue. And it's the city, we will need to make up that money somehow. And when you anticipate the budget that we already have, I think it's unrealistic that nothing is going to change.
Have you crunched the numbers for how far expenditures are outpacing revenue if ARPA was not part of the picture?
I don't think that we did that just because it's a core part of our, it's just a core. ARPA is budgeted. We budget for it, have been budgeting for it annually, so we have not removed it. Anyone else?
Any last questions?
Thank you. Thanks everybody for coming. If you need anything, you can ask me, Coleman, Doug, everybody's here. So thank you.